Understanding Marginal Benefit, a Comprehensive Guide. Introduction. In the realm of economics, understanding how consumers value goods and services is crucial. One key concept that emerges in this context is marginal benefit. Marginal benefit plays a vital role not just in consumer behavior but also in production and marketing strategies. This article will delve into what marginal benefit is, its implications for consumers and producers, and other critical aspects of this concept. What is marginal benefit? Marginal benefit can be defined as the maximum amount a consumer is willing to pay for an additional unit of a good or service. It captures the additional satisfaction or utility that a consumer derives from consuming one more unit. As consumers purchase more units of a good, their willingness to pay for each subsequent unit often decreases, a phenomenon known as the law of diminishing marginal benefit. Key takeaways. Definition: marginal benefits represent the maximum price a consumer would be willing to pay for an additional good or service. Satisfaction level: it measures the incremental satisfaction derived from purchasing an additional unit. Diminishing returns: the marginal benefit typically decreases as consumer consumption increases. Consistent valuation: for some essential items, like medications, the marginal benefit may remain constant regardless of consumption levels. The concept of marginal utility. Marginal benefit is closely related to the idea of marginal utility, which refers to the added satisfaction a consumer gets from consuming an additional unit of a good. Economists use utils to express this satisfaction, providing a subjective measure of utility. If a consumer buys a burger for $10, they derive at least $10 worth of perceived value. However, if they are only willing to pay $5 for a second burger, it indicates that the marginal benefit of the second burger is between $5 and $6. Example: burgers and satisfaction. First burger, willing to pay $10, indicating high utility. Second burger, willing to pay $5, demonstrating diminishing marginal benefit. The law of diminishing marginal benefit. The law of diminishing marginal benefit posits that as a consumer consumes more units of a good, the extra satisfaction gained from each subsequent unit declines. For instance, if a consumer purchases an initial burger and experiences high satisfaction, the joy from consuming a second burger is often less intense as compared to the first one. Thus, if a consumer is willing to pay $10 for the first burger but only $9 for the second, it reflects the decreasing marginal benefit. Formula for marginal benefit. To calculate marginal benefit quantitatively, you can use the following formula. \text, marginal benefit, equals \frac, text, total additional benefit, \text, total additional goods consumed, \. This mathematical expression helps economists and businesses assess value across different units of consumption. Different types of marginal benefits. Marginal benefits can be categorized into three types. 1. Positive marginal benefits imply that the consumer experiences a net gain from consuming additional units, though this benefit may diminish over time. 2. Negative marginal benefits occur when additional consumption leads to dissatisfaction or harm. For example, excessive consumption of junk food may reduce overall satisfaction. 3. Zero marginal benefits exist when additional consumption does not change consumer satisfaction, as positive and negative effects balance each other out. Marginal benefits and market pricing. Although a consumer might be willing to pay $10 for a burger, the actual market price may differ due to various forces, such as supply and demand. This gap between perceived value and market price generates consumer surplus, the benefit derived when consumers pay less than what they are willing to pay. Consumer surplus versus economic surplus. Consumer surplus, the difference between what consumers are willing to pay versus what they actually pay. Economic surplus, the total benefit that society gains from the consumption of goods and services, which includes both consumer and producer surplus. Marginal benefit for businesses. Understanding marginal benefit is essential for businesses as it helps in making informed pricing and marketing decisions. When customers evaluate whether to purchase an additional unit, they compare the marginal benefit with the marginal cost, the cost incurred by producing one more unit. If the marginal benefit exceeds the marginal cost, consumers are likely to make the purchase. Example: burger pricing. First burger, bought for $10, perceived marginal benefit is $10. Second burger, if they value it at $9, and the cost is also $9, the purchase is justified. Marginal benefit versus marginal cost. Understanding the relationship between marginal benefit and marginal cost is crucial in production. While marginal benefits focus on consumer satisfaction, marginal cost pertains to the producer's expenses. As production increases, both marginal benefit and marginal cost can change due to factors like economies of scale. Example: factory production. Using a hypothetical factory producing paper cups. Initially, producing fewer units incurs lower marginal costs. When production maxes out, the marginal cost may rise, affecting the producer's profit margins. Conclusion: the bottom line. Marginal benefit is a foundational concept in microeconomics that illustrates the value consumers derive from additional consumption. By understanding both marginal benefit and its counterpart, marginal cost, producers can optimize their pricing strategies while consumers can make more informed purchasing decisions. In essence, marginal benefits play a pivotal role in shaping market dynamics and consumer behavior, making it a critical area of study within economics.